Ladies and gentlemen, hold onto your seats, because the gold market just got a jolt of adrenaline, a bipartisan tectonic shift triggered by U.S. tariffs on Swiss gold bars has sent New York futures prices rocketing to uncharted territory. They say markets move on whispers. But this was no whisper. This was a cannon blast at close range. Overnight, a decision came down that sent tremors through one of the oldest and most stable markets in the world. A 39% tariff, not on an obscure commodity, not on a luxury good for the elite, but on gold. Swiss gold, the very backbone of global bullion supply. To the untrained eye, this might sound like just another trade measure. To those who understand markets, it's a grenade thrown into the engine room. For decades, Switzerland's refineries have been the silent workhorses of the gold trade, processing bars that move invisibly between vaults, banks, and nations. Those kilo bars and hun redounced blocks weren't just metal. They were liquidity, they were trust, they were the oil in the gears of global finance, and just like that overnight, the rules changed. Imagine a marathon runner at mile 25, lungs burning, eyes on the finish line, and someone drops a backpack of bricks on his shoulders. That's what these refiners felt. They weren't prepared. They couldn't be prepared. You don't hedge against the unimaginable. Now they face choices that aren't choices at all. Absorb the cost and bleed cash, pass it on and risk losing customers, or stop running entirely. Each option carries a price tag. Each option creates ripples that extend far beyond their factories in Valcombe or Pamp. And the markets, they reacted like markets always do when stability is shattered. They panicked. Gold futures in New York didn't just rise. They exploded. Record highs. Traders scrambled to cover positions. Arbitrage windows slammed shut. The quiet hum of predictable trade was replaced by the chaos of survival mode. In the space of hours, the predictable became volatile. The steady became dangerous. This is what happens when trust is broken. What's remarkable is that this didn't happen because gold lost value. No scandal, no manipulation, no collapse in demand. The gold itself is as pure, as heavy, as precious as it was yesterday. What changed was the human-made barrier between seller and buyer. What changed was the artificial cost, the man-made friction. Tariffs aren't a reflection of reality. They're an intervention in it. And when you interfere with something as fundamental as the flow of gold, you interfere with the very perception of value. You see, gold is more than a shiny rock. It is the one financial asset that doesn't require a promise from anyone. It's immune to credit risk. It's independent of political borders. But when you suddenly attach a massive price penalty to moving it, you distort its role as a universal equalizer. That distortion is now playing out in every corner of the market, from miners reconsidering where they send their output, to jewelers calculating how much their raw material will cost in 6 months, to central banks watching nervously from the sidelines. This is not just about Switzerland, it's about the precedent it sets. Today it's tariffs on kilo bars from Swiss refiners. Tomorrow it could be silver from Mexico, platinum from South Africa, palladium from Russia. Once you accept that essential financial commodities are tools in a political chess game, you open the door to weaponizing the system itself. That's when trust doesn't just erode, it implodes. And here's the part people often miss. In every dislocation, there are winners. Somewhere right now, there's a trader making a killing because they saw the fracture before the rest. Somewhere, a country is renegotiating its trade agreements to take advantage of the disruption. Somewhere, a competitor refinery is sharpening its pitch to clients who suddenly find their trusted supplier priced out of the game. But the rest are standing in the wreckage of what they thought was predictable. They're learning the hard way that markets don't reward comfort, that stability is a privilege, not a right, that the ground beneath your feet can vanish without warning, and when it does, the question isn't why it happened. The question is, what will you do now? Because here's the truth. This shockwave will pass. The panic will fade, but the scar tissue will remain. Traders will remember that the rules can change overnight. Buyers will remember that a trusted route can be blocked in an instant. And in the next crisis, because there will be a next crisis, they will act faster, harder, and with less mercy. This is the reality of a global system where economics, politics, and human ambition collide. No one is immune, not the producers, not the traders, not even the governments who think they control the game. And if you're not building strategies for a world where the next shock is always one decision away, you're not playing. You're waiting to be played. It's one thing for a market to rise. That's normal. Prices move, demand shifts, supply adjusts. That's the rhythm of commerce. But there's another kind of movement, one that doesn't feel like a natural climb, but like a volcano erupting. That's what we've just seen. Gold prices didn't simply edge higher. They broke barriers, smashed ceilings, and charged into record territory as if the laws of gravity no longer applied. Understand this, Mark. It's don't make records in silence. They do it with noise, and this time the noise wasn't just traders celebrating gains. It was the deafening sound of panic buying, margin calls, and frantic repositioning. Prices surged past numbers analysts had only whispered about months ago. The charts didn't slope upward, they shot like rockets, and when that happens in a commodity like gold, it's not just a story for investors. It's a signal to the entire global economy. Gold doesn't move like tech stocks or cryptocurrencies. It's the asset of last resort, the ancient fallback when trust in paper begins to fray. When it starts hitting new highs, it's telling you that confidence somewhere, maybe everywhere, is breaking down. And this time, the trigger wasn't a slow burn of inflation data or an extended geopolitical standoff. It was sudden, a tariff decision that ricocheted through markets like a bullet through glass. One announcement, one change in the rules, and the market went from calm to chaos in hours. Think about that for a moment. People who thought they were hedged were suddenly exposed. Traders who believed they had time to adjust found themselves chasing the market at a sprint. Buyers who had been patient, waiting for a dip, now faced the nightmare scenario, prices running away from them. And the psychology shifted instantly. No longer was the question, should I buy gold? It became, can I afford not to? That's when markets hit escape velocity. What's critical here is the way these record levels reshape behavior. In normal times, a price spike might tempt sellers to cash in, adding supply and cooling the rally. But this is different. Here, the very people holding gold see the surge as proof they should hold tighter. Every tick higher feels like confirmation that the move isn't done. That creates a feedback loop. Tight supply feeding higher prices, which feeds tighter supply. It's not just a rally, it's a squeeze on reality itself. And for those on the wrong side of the trade, this is pain amplified. If you were short gold, you weren't just losing money. You were watching the losses compound at a speed that made sleep impossible. Calls to brokers weren't about strategy, they were about survival. Liquidations were forced, portfolios were shredded, and reputations were put on the line. Some careers won't survive this surge. That's the ruthless truth of markets when they go vertical. Here's the irony. Most people will look at these record highs and think it's a win for the gold market. But anyone who's lived through similar moments knows it's not that simple. Records aren't destinations. They're warning signs. They tell you that the balance of supply, demand, and trust has been knocked off its axis. They warn that what goes up at this speed doesn't glide gently down, it falls hard, and when it does, the wreckage isn't evenly distributed. Some walk away richer than they imagined, others crawl away broken. Yet, despite that risk, the psychology of fear and greed keeps the cycle alive. Right now, the narrative has shifted. It's no longer about steady portfolio diversification. It's about missing out on a generational run. People are willing to buy at all-time highs because they believe the next number will be even higher. And as long as that belief holds, the momentum feeds itself. But here's the part that should keep every serious observer away. Record highs in gold aren't just a market event. They're a reflection of something deeper. They are a mirror, showing the cracks in the financial system, the fragility of trade relationships, and the desperation of those seeking safety. You don't get here in a healthy, confident economy. You get here when the foundations are shaking, and people are rushing to anchor themselves to something solid. So yes, these record prices are impressive. They're historic. They'll be remembered in the annals of market law. But make no mistake, behind every record there's a reason, and those reasons are rarely comforting. In the heat of this surge, while the headlines scream about new highs, the smartest minds aren't cheering. They're watching, calculating, preparing, because they know this. Markets can make you rich in moments like this, but they can just as easily take everything back when the fever breaks, and it always breaks. Switzerland has built an entire global reputation on precision, stability, and trust. Its watches keep perfect time, its banks guard secrets, and its gold refineries turn rough, unassuming chunks of metal into flawless bars that move silently across the world's financial arteries. This is a country that has mastered the art of being indispensable without ever shouting about it. But now, the calm, methodical hum of that machine has been interrupted. The tariffs have landed, and with them, the certainty that Switzerland has enjoyed for decades is showing cracks. This isn't just a hit to an industry. It's a shock to an identity. For generations, Swiss refiners have been the quiet giants of the gold market, processing the lion's share of the world's bullion with a consistency that made them almost invisible. No headlines, no scandals, just the smooth flow of metal from miner to market. But when the largest consumer nation suddenly decides that moving your gold across their border comes at a 39% penalty, invisibility becomes impossible. Inside Switzerland, the reaction is part disbelief, part calculation. Disbelief because this is not a country accustomed to being targeted in global trade disputes. It's the neutral ground, the safe place. Calculation because every refinery, every exporter, every logistic operator now has to run the numbers. What happens if orders dry up? What happens if margins collapse? What happens if the cost of doing business with your largest market becomes unbearable? These are not academic questions. They are existential ones. The gold industry here isn't a niche craft. It's a pillar. Thousands of jobs depend on it. Entire local economies breathe in rhythm with the shipments moving in and out of these high-security facilities. When that rhythm falters, it's not just balance sheets that suffer its livelihoods. It's the quiet pride of craftsmen and engineers who've built careers on perfecting a product that, until now, seemed untouchable. There's also the political layer. Switzerland is not part of the European Union, but it has always navigated the geopolitical landscape with surgical precision, lining where necessary, distancing where prudent. This tariff, however, forces a different kind of conversation. Negotiators are already at the table, but the clock is ticking loudly. Every day without resolution is a day when clients reconsider their supply chains, when competitors step into the vacuum, when trust begins to fray. And make no mistake, competitors are circling. Other refining hubs are already sharpening their pitches, promising stable supply without the baggage of a tariff war. Once a buyer switches suppliers, winning them back is not just about price. It's about proving that the disruption will never happen again. That's a promise Switzerland can't make right now. What's fascinating and dangerous is how quickly the psychological shift happens. For years, Swiss gold was the gold standard. Literally. Buyers didn't think about it, they just trusted it. Now they're asking questions they never asked before. Is there an alternative source? Is the quality difference worth the premium? Can we redesign our contracts to avoid exposure? In business, once people start asking those questions, you've already lost part of your position. And yet, this is not the end of the story. If history has shown anything, it's that Switzerland doesn't panic, it adapts. The country has weathered banking crises, currency shocks, and diplomatic storms. The playbook here will be negotiation, innovation, and efficiency. But this time, the challenge is steeper because the trigger didn't come from internal weakness. It came from an external decision that Switzerland cannot control. That lack of control is what stings the most. The irony is that the rest of the world still sees Swiss gold as the pinnacle of quality. The bars haven't lost their purity, their shine, or their demand. What's changed is the cost of moving them. And in a market where every fraction of a percent matters, a 39% surcharge is not a cost you absorb. It's a cost that changes the game. So, Switzerland stands at a crossroads. One road leads to a rapid diplomatic solution, a return to the steady hum of the refining business, and a reaffirmation of its position as the world's trusted source. The other leads to a slow erosion of dominance as buyers diversify away, margins thin, and the golden grip slips. The world is watching because this is more than a story about tariffs. It's a story about what happens when even the most stable players in the global economy are reminded that stability is not a birthright. It's a privilege. And privileges, as Switzerland is now learning, can be challenged in a single stroke. The question now is not whether they can survive this. They can. The question is whether they can emerge with the same unshakable aura they had before. Because once the edge is tested, it's never quite the same. Markets are built on rhythm. Buyers and sellers moving in sync, prices finding balance, liquidity flowing like a steady river. But every so often, something snaps. That rhythm breaks, the current becomes unpredictable, and those who thought they were swimming suddenly realize they're being dragged by a rip tide. That's what happens in a true dislocation, when the normal mechanics of trade stop working, and every player in the system is forced to improvise in real time. The moment the tariff news hit, the gold market's wiring lit up with stress signals. Arbitrage opportunities, those clean, mathematical trades that balance prices between regions, vanished in minutes. Supply lines that had been reliable for decades became question marks overnight. The predictable dance between physical gold and paper contracts collapsed. Futures prices raced ahead of spot prices, and the usual tools to close that gap stopped functioning. That's not volatility, that's structural failure. In a functioning market, every buyer knows they can find a seller, and every seller knows they can find a buyer. In a dislocated market, that assumption is gone. Suddenly, gold that should move freely between Switzerland, London, and New York is trapped by new costs, logistical bottlenecks, and political uncertainty. And when physical supply is trapped, the futures market, the paper market, starts to detach from reality. Prices become signals of fear rather than reflections of trade. This is where the real damage happens. The hedging strategies built over years, sometimes decades, stop protecting the people who rely on them. A miner who sold futures to lock in a price might find their counterparty in trouble. A jeweler who budgeted for gold at one cost is now staring at invoices that are 20, 30, even 40% higher. The carefully woven fabric of contracts, deliveries, and settlements starts to fray at every edge, and when markets fray, behavior changes. Traders stop thinking about efficiency and start thinking about survival. Liquidity dries up because no one wants to commit to a deal they might regret in an hour. Spreads widen. The cost of doing business climbs. The calm confidence that underpins risk-taking is replaced by hesitation, and hesitation is poison in a fast-moving market. Some people will tell you dislocations are opportunities, and they're right. For the few who can stay calm, read the chaos, and move quickly, fortunes can be made. But for most, dislocation is a destroyer. It eats into capital, burns through credit lines, and exposes weaknesses that were hidden when the market was smooth. The traders who were just good enough in normal times get found out when the structure disappears. What's important to understand is that this isn't just about gold. The same mechanics apply to every interconnected market. When the gears in one place seize up, the pressure ripples outward. A refinery in Switzerland can't ship gold to New York. That disrupts a bank's delivery schedule. That bank adjusts its lending against gold inventory. That adjustment ripples into other credit markets. Before long, the original shock has multiplied, touching corners of finance that seem far removed from the cause. This is the hidden cost of global interdependence. It's efficient when everything works, but when something breaks, the efficiency that once saved money now magnifies the pain. The tighter the connections, the faster the trouble spreads. And gold, for all its solidity, is at the center of one of the tightest networks in the world. In a dislocation, trust becomes the most valuable commodity. Not trust in the metal. Gold will always be gold, but trust in counterparties, in contracts, in the ability to deliver on promises. The players who can maintain that trust will survive. The ones who lose it will find themselves locked out, no matter how much they're willing to pay. The unsettling truth is that dislocations don't heal instantly. Even when the immediate cause is resolved, the memory of the break lingers. People remember who failed to deliver. They remember which prices blew out, which spreads collapsed, which counterparties disappeared when the storm hit. That memory changes the way they behave next time, and there will always be a next time. So this moment in the gold market is more than a price spike. It's a stress test. It's the system revealing where it's strong and where it's dangerously fragile. The question is not just who survives the chaos, it's who learns from it, and who simply waits for the next dislocation to come and tear them apart all over again. Every major market event sends a message. But some don't just whisper to investors. They broadcast to the entire global system. This isn't about one commodity, one country, or one policy decision. This is about what happens when the world's most ancient store of value collides with the realities of modern geopolitics and monetary fragility. It's about what that collision tells us about where the global economy is headed. Gold has always been the litmus test for confidence. When faith in paper holds strong, gold behaves like any other asset, priced on demand, supply, and a sprinkle of speculation. But when that faith wavers, gold stops playing by those rules. It becomes the safe harbor in a storm, the vault where fear is stored. That's why every time it surges, you have to ask the question, what exactly are people running from? The recent shock in the market has peeled back the curtain on vulnerabilities that were already there. Inflation fears didn't vanish when central banks hiked rates. They merely hid in the shadows. The specter of economic slowdown didn't dissolve with upbeat headlines. It lingered in the numbers no one wanted to talk about. Add to that the growing distrust between major trading partners, and you have a combustible mix. The tariff may have been the spark, but the fuel was already stacked high. And here's the uncomfortable truth. This isn't just about protecting domestic industries or adjusting trade balances. It's about power, monetary power. When gold's price moves this sharply, it reminds us that the monetary system is still, at its core, a confidence game. Currencies function because people believe they will tomorrow what they do today. Debt markets work because lenders trust borrowers to repay in a currency that holds its value. Shake that belief, and everything built on top of it begins to wobble. In boardrooms and central banks, the conversation now shifts. Some will frame this as a short-term supply shock, something that can be negotiated away. Others will see it as evidence that the world is inching toward a monetary reset, one where gold, after decades in the background, takes on a more visible role in global finance. And don't think for a second that governments and large institutions aren't gaming out scenarios where their gold reserves suddenly matter more than the digits in their foreign exchange accounts. What's also becoming clear is that financial globalization is entering a more fractured phase. The era where supply chains could stretch effortlessly across borders, where money could move freely between financial hubs without political interference, is fading. The tariff is just one example of a broader trend: economic nationalism. Nations are realizing that control over strategic resources, including precious metals, can be leveraged for political advantage. The more this happens, the less predictable and less stable the global trading environment becomes. For investors, the macro signal is as loud as it gets. If gold's move was purely speculative, it would fade as quickly as it came. But when it's driven by both immediate shock and deeper systemic doubt, it tends to stick. That's why central banks across emerging markets have been quietly increasing their gold holdings in recent years. They understand that in a world where trust can evaporate overnight, tangible reserves aren't a luxury, they're insurance. And that brings us to the most important implication of all, the shift in mindset. When gold surges like this, it subtly changes the way people think about money itself. Suddenly, holding cash feels riskier than holding metal. Suddenly, the cost of not owning gold becomes part of the conversation. And when enough people and institutions make that mental shift, the demand curve changes in ways that can't easily be reversed. Of course, there's a paradox here. A world that leans too heavily on gold as a safeguard is also a world where liquidity tightens, growth slows, and capital becomes more cautious. If the message of this moment is that trust in fiat systems is weakening, the long-term consequence could be a more defensive, less dynamic global economy. That's the double edge of gold's rise. It offers protection, but it also signals retreat. So this is bigger than one market spike. This is the market speaking in its most ancient language, telling us that the balance between risk and safety is shifting, telling us that the next decade may not look like the last. And if you're listening closely, it's also reminding you of something else. In a world where value is increasingly abstract, the things that endure are the things that have endured for centuries. Ignore that at your own risk. So ask yourself, in a world trembling under tariff shocks, economic turbulence, and uncertain central bank maneuvers, where does value truly lie? Not in paper promises, not in fleeting bubbles. It's in real money and gold. And if you're not realigning right now, you're watching the future unfold without you. Remember, value isn't given, it's claimed, and in this era under fire, those who understand will win. Thank you.